Welcome everyone. We're going to start. My name is Glenn Thompson, as you see, and I've been working with Pacific Trading Academy since the beginning, 15 plus years. If you have questions that I'm not able to address in today's presentation, please feel free to contact us, 800-339-8588. You can also take a look at the website, www.pacifictradingacademy.com. Peter Newman handles all of the kind of the business affairs and any arrangements. So if you need further access to myself, do so via contacting Peter Newman. He would be the specific point of contact. And again, welcome. And we are recording today's presentation, so you can access it on the archives at the website. Emotional states of trading is the topic. If I should have time for questions at the end. As an overview to today's presentation, and I last talked about these issues and had a webinar on this topic, I think it was at the end of last year. If I recall, it was last November or so. So it's been a while, and the office called me earlier, and I guess at the end of last week actually, and asked me if I would repeat the presentation. So here we are. Essentially, the process of investing and speculation and any type of investing there are three underlying components. The analysis, which is what most of us focus on most of the time, and the point of the analysis is to help us locate good trades where we feel we have some advantage and edge. And that certainly is central, but it's woefully insufficient as a single entity and component to improve our odds for financial success. We've got to bring along and complement the analysis with what I call money management, what most traders refer to as money management. Money management really speaks to how you manage your risk and your money, your bankroll. Bankroll and risk management is what the topic of money management deals with. And thirdly and lastly, and by no means less important, to me, of greatest importance, is trading psychology, emotional states of trading. And many traders, especially when we're getting started in this process and new to the business, tend to feel or downplay the importance of this. But today's presentation, I think, will highlight how important and critical it is. Any one of these items, the analysis, the risk management and money management and psychology, if not paid enough attention to, if we give it short shrift, will hurt us or has the potential to hurt us. So we want to ensure that we solidify our coming to bat, as it were, in all three of these areas. Trading psychology really seeks at its best to identify biases that are behavioral. We all have emotional and behavioral and cultural habits and tendencies that, if allowed full sway, when we bring who we are to the table as investors, could in systematic ways be adversarial to our objectives in the market. Behavioral biases are essentially systematic errors in our judgment, and if we have judgmental errors that can clearly alter optimal outcomes in our trading in the positions we establish in markets for the purpose of profiting. Systematic errors or behavioral biases, I guess, have two primary sources: those that are intellectual or cognitive, and those that are kind of emotional or derive out of our pure intuition. Cognitive biases, which arise again due to faulty reasoning. Guys, I haven't, someone's saying, or Geo is indicating no slides have traded, or no, you're not seeing any slides. Can you see? I'm still on the first slide, Geo. Let me just make sure. Can you see the slide, folks, before I proceed any further? I have not advanced the slideshow, so I'm still on the entry slide. Let me advance it and just make sure you guys are here and we have the visual. Can you see that, guys? Okay, I just moved the slide presentation. Can we, before I proceed any further, I hadn't really started, I was just kind of giving you an overview. No slide. Okay, I'm still getting, Thank you. Good for the feedback. Let me just make sure. Can you guys see anything? Let me go back to the previous slide. Can you see anything? This is a picture. This is just the intro. I'm still okay. All right. Okay, you do see this is the intro slide, and I hadn't. Okay, good. Thank you. Thanks, guys. I'm not sure what happened, but as long as you're able to see. All right, and here. If at any point we lose audio or visual, please just on the control panel on the right indicate, and I'll adjust it and hopefully correct it. Fortunately, I was just kind of giving a brief overview. Psychology. Let me get into this, and as long as you guys, again, if there are any questions that arise, if I'm able to kind of keep track of my narrative and also see a question that I think would fit in and not interrupt the flow, I'll address it as we go through the process of the slide presentation. If not, again, there's time at the end of today's presentation for a more thorough redress of any questions you have. So the components, psychology. What is psychology? Okay, the scientific study of the human mind and its functions, especially those affecting behavior in a given context. So we're going to limit the context I want to talk about today to that of speculation, to investing. Psychology in a broader sense deals with any and all components or parameters that would impact and determine one's internal state, which in turn is projected to the world external to an individual entity. But as far as what I want to talk about, I want to limit this dynamic in this relationship and discuss how it can adversely impact our trading and our investing, and what we can do to offset and mitigate against factors that could harm our analysis or our bankroll management or our risk management. So I was simply saying that there are parameters, there are factors, there are vectors, there are forces in the world that can create what I call systematic errors in judgment or behavioral biases, and they typically either start from one of two places. They're born or they arise out of our intuition and or our reasoning. We either have faulty intuition or faulty or faulty reasoning. The biases and errors that arise in our judgment due to reasoning are more readily fixable. We can typically amend those situations. Intuition it's more of a nebulous concept by itself, much less trying to determine objectively what any component or anything that we come up with or into it, whether, assigning whether or not it's right or wrong is a much challenging, much greater in terms of trying to figure out a harder task to figure out. Nevertheless, there's some things we can do to more greatly ensure we have a proper internal state consistent with increasing the frequency of success in our trades. All right. Trading psychology, the necessity of ensuring an internal emotional state appropriate to the speculative process. Yeah, I didn't even know this slide was here. This is I don't want to. Yeah, I'm going to skip it because it's not inconsistent with the program. It's important, but it's something else. Okay, I should have taken that slide out. Trading is an enterprise. Trading, and so there's what I alluded to a moment ago. There's the analysis, and that is the point and the utility and the purpose ultimately at the end of the day of any and all models or indicators or systems or methods that we're employing is to help us find good trades, and that's what we have shown on the left side of the screen here. On the right side is the psychology, and this is what I just alluded to verbally. Behavioral biases are both cognitive and emotional, faulty reasoning born of intuition. All right, so that's just giving us some context by which we can consider where some of the faulty judgments arise, how they bubble up to the surface. And so once we understand a little bit of the origin of these problems, then we're in a better position, or we have a better, unique perspective to mitigate and fix the problem. Self-attribution is one type of bias. I would say it's more of a cognitive situation, or it arises out of our faulty reasoning. To ascribe, and what is it? It's to ascribe our success to skill or hard work. There are reasons why we do this as traders, because in many other disciplines in life, there is a very intimate and clear-cut relationship between the amount of effort we put into something and the results we obtain. It's not as clear and as defined in this business. I am always quick to tell people I've consulted and consult right now and have worked with over years, the market, financial markets don't know how much you know or how little you know. They don't know how much effort and work and money and investment and time and effort you've put into doing what you need to do to understand what or a market is doing. And to really push that point, I always tell we want to be in constant remembrance that markets, if they could comprehend anything, don't really care. A financial market is, in its rawest, deepest form, it's a phrase that we use to describe and it's something that fluctuates, and we as human beings have more or less imposed this concept of there are items, there are commodities, there are instruments, you can call it what you will, they change in value. It's not a static situation. And without going into detail here, we have systematically created arenas for these things to fluctuate. We call them markets in value, and external players, you and I, in this process, if we're astute enough and bring enough of good things together, we're able to sometimes generate returns in dollars and cents terms. To blame your failure on external factors or bad luck, well, that's convenient. Dangerous. What this slide is saying, essentially, what this principle is saying is, to the extent we assign any outcomes that in our endeavors, whether they're good or bad, to our own efforts, that can be dangerous. If we don't perceive errors as errors, we can't learn from them. Attributing lucky outcomes to skill can lead to overconfidence. An immediate negative and a specific negative consequence of becoming overconfident is it causes us to too readily increase our size and frequency of trading. And that sets us up for, that increases on the continuum of probabilities our chances for failure in dollars and cents, in a metric of dollars and cents. So we don't want to, we got to move this, we need to, this is the problem, attributing too much of the outcomes to our own efforts. And I know this is difficult because most things, many other things, if not most, other than what the process of trading involves, are direct consequences of what we do or don't do. So we have to realize this and make a disconnect. We have to cut ourselves off from realizing if I'm going to make a mistake, we always want to err on the side of attributing our failures and our missteps to ourselves, but less frequently attributing our successes to our whatever we thought of the investment we put into something. Overconfidence, it's a cognitive bias that arises from our incorrect reasoning. Our thought process is incorrect somehow. An incorrect view that is a lack of confidence, or an incorrect view is that a lack of confidence is holding us back, or you back, as a trader, versus acquiring and developing skill and learning to be confident in the skill. What's a good example? Sports provide a very good arena for analogies to the world of investing. I doubt very seriously that, say, a great tennis players, i.e. Roger Federer, or a great basketball player, LeBron James, Michael Jordan, etc., Larry Bird, all of these people, I think they have a degree of confidence. It might be great confidence as a consequence of knowing that they have had a degree of preparedness. So we never want to confuse cause and effect. I acquire whatever level of confidence because I recognize I have a competency. I don't have competency because I imbue or if I say I'm confident. That's the incorrect way of thinking of it. I don't immediately transmute to a state of supreme confidence because I believe so, or my competence does not come from my confidence. Rather, your confidence should arise from your competence. Overconfidence leads to overtrading and incorrect assessment of risks associated with extreme moves, both of which hurt the long-run outcomes. Most important thing to remember is to stay in the game. Once you have an edge, if you can play long enough, the law of large numbers will eventually make you rich. Don't jeopardize your future trading. The key, this is getting off subject, but really I'll swing back full circle in a few minutes. This is the key to all speculation. It overrides whatever edge you have. So, in fact, or whatever. Yes, that's true. But more to the point, what the essence of this, the final point at the bottom of the slide indicates is, don't jeopardize your future trading. Trading is a probability enterprise. It's solely based on probabilities. Anything and everything we can do to elongate our sample size or sample window or period. Once you have an edge, if you can play long enough, the law of large numbers will eventually make you rich. This concept applies whether you're a day trader and in the extreme, say a high frequency trader in the limit, all the way through the opposite extreme to a long-term investor holding positions for years and every time window in between. The concept is universal to regardless of any type of instrument you trade, whether you're trading equities and stocks, options on that, futures, derivatives, swaptions, options, forex, you name it. These are just little instruments that are containers of energy. And the way to maximize from the outside looking in, the way to maximize our chances is to maximize the long run. It's like odds. When you flip the coin, it's 50-50 outcome. But you only begin to realize that distribution of outcomes, wins or losses, or in the analogy of the coin flip, heads or tails, the more times you flip the coin, the more times you enter the market. The frequency of opportunities is indirectly, if not perfectly directly, but more or less directly related to, if not perfectly direct, it's more or less a direct relationship to the extent how long your period is. The longer, anything we can do to increase our window of opportunity will serve to ensure that the edge implicit in your methodology, in your system, will bubble up to the surface. So that's important. The availability heuristic. This is what heuristic is just I'm utilizing it on the slide merely as a fancy word to illustrate one type of bias. And it's a specific type of bias. It refers to the tendency to base decisions on the first piece of evidence that comes to mind. I am often guilty of that. And there's a deeper, I am guilty, and I'm going to be forthright. I'm guilty of it because I tend sometimes, as a weakness that I have long ago identified, to be lazy. So out of my laziness, very often the first thing that looks like it fits the criteria, I am often too readily inclined to accept it. And the danger is that just because something fits a model and fits, just because the block fits in the square and there's a reconciliation and things look at least superficially to work out, doesn't mean it's the correct solution. It might be, but it might not be. Estimation of the likelihood of events on the basis of how easy those events are to imagine. Well, can you imagine? That's the problem. Here's why. Just because something lends itself and you immediately come up with the quote-unquote bright idea of the moment doesn't make it applicable and relevant to the situation. It might be, but it might not be. Something that you don't as readily conjure up or conjecture or think of or imagine or come to comprehend might be more the entity, the thought, the concept, the situation that would move you further towards your objective of profitability. I'm not saying that the item, the method, the pathway that immediately comes to mind, the solution that you immediately come to is necessarily wrong, but I'm saying just because it makes sense up front doesn't guarantee with perfect certainty that it is the optimal solution to what you're trying to achieve, especially in markets. Remember, with financial markets, it turns out, I'll state this explicitly, they are infinitely complex or complicated, right up there with weather systems, weather patterns, and hydrodynamic flow systems. The complexity of and I'm talking in a generic sense, financial market complexity is such a high pitch level, we don't completely understand it. We have no one equation, we have no set of equations. The greatest minds in all of mankind have individually and collectively attempted to understand financial market behavior, structure, and mechanics. And thus far as I'm aware, we have not perfectly cracked that nut, so to speak. Doesn't mean we can't profit, it just means that's the state of affairs. I consider that to be a positive, that we at least know that. You know, how much worse would it be in the bigger picture, in the bigger scheme of things, if we thought, if we were if we were so deceived that we thought we understood, we would really be, the results we could obtain would be much less optimal than they already are. Availability, we've got to make sure, just because, to simplify this, getting right to the point, it means necessarily the first thing that comes to mind that might seem superficially or at any level to be appropriate doesn't guarantee it is the correct solution. Doesn't mean it's not, but it doesn't mean it is the point. Short-term thinking, the irrational preference for short-term gains at the expense of long-term performance. I'm going to use an example. For those of you who are options traders, I know a lot of beginning, and I mean that in every sense of the word, people who really don't comprehend the options markets. And this slide, short-term thinking, has applications. I'm not just it's not applicable specifically to trading in premiums and in the options market, but I'm going to use an options example. A lot of traders who have a facile and not a complete comprehension of how options as a mechanism of trading vehicles operate and the mechanics of options soon learn, because there are more states for an underlying market that are consistent with profitable short vega or short gamma option positions, if you know what I mean. I'm speaking to the options people who really understand that. If you didn't understand the term, don't worry about that. This is just an example. Feel that they are, because they offer a consistency of returns where long gamma positions don't have the same high frequency of positive gammas, that selling premium is preferable or a better strategy than buying premium. Completely incorrect thinking if you're an options trader. That is one example of what the broader paradigm of this behavioral bias is about. Short-term gains at the expense of long-term performance. If my long-term expectation, magnitude of outcome, or significance or quality of outcome times probability of achieving a certain outcome. Think of lotteries. What is the expectation amount or magnitude I would assign to a lottery outcome is due to what is the probability of a certain outcome and what is that outcome. So as I increase the probability of a given outcome and I increase the net result of that outcome, my expectation goes up. You see? So by going back to the analogy of an options trader, if I'm trading options, the probability, the magnitude of the outcome of a long gamma position, meaning I buy an option, typically is going to be much greater than the probability, the magnitude of a gain of a short option position. When you sell premium, you have a finite maximum possible return. When you gain premium, it's open-ended in principle. Okay. Someone, let me just see here if I have a question. A bird in the hand is worth 2 in the bush. Well, that's whoever's, yes, I agree with that principle, that cliche and maxim, and it's a cliche because there's basis in underlying fact. I totally agree. The analogy I was using to support a broader idea that the slide is bringing out is, yes, in general, unless and until the single bird in the hand, unless you capture the 2 birds in the bush. There are times when you realize in a comparative evaluation that my odds for capturing the 2 birds in the bush and the 2 birds in the bush, assuming I do capture them, quantitatively outweigh the single bird in my hand. I'm not saying, but to this principle's point, there are alternate times when the single bird in the hand is worth more than the 2, because I may have a lower probability of getting to that bush and getting those 2 birds. So I just want to point out, or this slide is pointing out, or the concept is pointing out, you have to look at each situation on its own terms. That's all. Let's see. Loss aversion, emotional bias. It's harder to, remember I said at the end, emotional biases arise out of our intuition, which are objectively much more challenging to figure out, understand, and thereby correct, and at least damage control on, do damage, and fix. In order to consistently win over the long term, it's necessary to accept losses, even to the point of seeing them as no more than the cost of doing business. That's an interesting concept. It flies in the face of everything in our world external to the investment. We are from the time we come into this existence, the time we're born to the time we leave and transition out, die, we want gain. We are programmed as humans for gain is positive, loss is negative. But this concept is and so out of that's an intellectual and an emotional. There's this intuition. It is so in its rat brain, if you will. It's instinctual, which kind of probably leads to the intuitional, and so we have this very hard bias against any type of losses. And all of a sudden, this concept is saying, when we enter into the realm of investing and trading and speculation, we have to come to terms with this and be comfortable with losses. In fact, the word loss should acquire a new meaning. It's a part of business. It's implicit in the process of us getting to a gain. It's a necessary step we must take in order to more greatly ensure our longer-term profitability. Studies show people dislike losses more than they like gains. Risk aversion, loss aversion. I'm so fearful. The opposite is nothing, or the concept nothing ventured, nothing gained, little cliche. Studies show people dislike losses more than they like gains. By analogies to sports again, I'm the base runner on first base. Do I attempt to steal? If I never attempt, nothing ventured, nothing gained, I'll never steal. If I never get up to the plate and swing the bat, I'll never get a base hit, much less a home run. This leads to get-evenitis, a condition where traders hold on to losing positions too long as they hope for them to rebound so they can exist without a scratch. Ace Greenberg was the former chairman, I believe, of Bear Stearns, big investment house. The definition of a good trader is a guy who takes losses. I completely agree. I would add or qualify that as long as those losses are, quote unquote, appropriately sized or small. But I'm sure Ace was implying that. He didn't state it. He understood that his audience understood that. But that is a critical concept to live by, to immerse ourselves in if we want to be successful as market operators in a dollars and cents way. The definition of a good trader is a guy who takes losses. Well, on the surface, if you're entering into the business of trading and speculation and market operations and investing at large, if you're just a newbie, what a concept. What a novel idea. In order to be a good trader, I got to take losses? I thought the whole object was to not take losses. No. Not taking losses makes common sense. Well, I love to tell people it is profound, but it's not like anything I came up with. Einstein said common sense, and I think we'll all realize this. We didn't need Einstein to tell us it, but he's, to drop a name. He said common sense is merely, so automatically he relegates it to a lower level than we might otherwise think, is merely nothing more than a collection of prejudices one has acquired from the time they are born through the time they're about 18 or 19 years old. Now, I'm not casting common sense out entirely. I'm not throwing it completely down the drain. It's good for something. It's good for common things. I'll give it even more credit. Common sense is good most of the time. 80% of my day-to-day activity in anything I do in my lifetime and in your lifetime, probably common sense is going to get you go a long way towards your success. Let me repeat that. Common sense for most of you, most of us, me, myself included, most of the time will get us through. Here's the rub. What the business of investing is not most of the time and most of the things. It is very, very different. It's polar opposite from any and every. That's most people in the investment world. Here's the even finer point to bring this point out. Most investors lose money. I dare say that most investors lose money in part, if not in total. There are a lot of factors and reasons why, but I dare say that one of them is because they are relying too greatly, too heavily on common sense. I understand why. It gets you through most other things. Why shouldn't it? Why wouldn't it be a worthy assistant in the process of this new endeavor I've taken on? Investing, trading, whatever you want to call it. It works for the most part in most other things. Let me just assume it works in this. Stop yourself right there. This is very different. And don't expect things that work normally to work. This is not a normal enterprise. Very abnormal. Sometimes it'll work, but don't rely on it solely, is what the gist of this slide is saying. Confirmation bias. Once we have formed this is important. I am often guilty of this. And this bias, no, it does not discriminate with how much education you have, how smart you could be a genius or not. You could have finished, you might not have gotten out of elementary school, or you could have a PhD and everything in between, what you know, what you don't know. Confirmation bias doesn't understand that it is indiscriminate in who it and how it arises and who it can take out. Once we have formed an opinion of a situation, this is more an emotional bias. This is going back to that primitive brain, rat brain, that can overwhelm any and everything you have learned and paid for informationally. You buy books, you attend seminars. Once we have formed an opinion of a situation, we react differently to confirming and contradictory evidence. Specifically, we emphasize confirming evidence and downplay contradictory evidence. Why is that? Probably it's so deeply embedded, probably has to do with, throughout the eons of our history, in order to survive, this bias has served as an internal biological survival mechanism, and that's why it's so strong. We need to believe in what we have done to move it, to enable us for survival. But yeah, good things in one arena can the underlying pathology that gives human beings immunity from malaria can, in a different setting, a different stage, under different conditions, manifest as a life-threatening disease, sickle cell. On the one hand, the underlying pathology and physical chemistry in a human body protecting them from a deadly disease. On a different set of circumstances, when you turn on different genes and so forth, can completely not be deadly. So it's how there's a very complicated interplay of forces here. But here's a study, 2004 experiment, 30 men included in the study, one half Republicans or conservatives, one half liberals or Democrats. During an MRI scan, subjects were asked to assess contradictory statements by two politicians, Bush and Kerry. The brain scan showed that the part of the brain associated with reasoning, the dorsolateral prefrontal cortex, was not involved when assessing the statements. The most active regions of the brain were those involved in processing emotions, conflict resolution, and making judgments about moral accountability. This means that after a certain point, we are not gaining anything new from evidence at all. In other words, let me translate. Once human beings reach a decision, I'm generalizing, I'm an extreme statement to make the point, no matter, you could present them with information counter to or that's contrary to their decision. And once that decision is believed in and is embedded too strongly in their psyche, there's nothing you can do to change their mind. That's it. That's final. I'm sticking to it. You can, I don't care. That's final answer. I could prove to you otherwise that your final answer is wrong, and it's still you're not going to change. Be very careful of that. That has wiped out the smartest, the best of us in this arena. So we got to be careful of that bias. All right. Let's see here. Hindsight bias. This is tricky. Once an event has occurred, we tend to think that the event was predictable. A single realized outcome is far easier for us to grasp than the multitude of possible outcomes that did not occur. This leads us to overestimate the accuracy of our predictions as we retroactively fit them to data. This also goes by the name of I knew it all along effect. An obvious danger of this phenomenon is that it often leads to too large a trade size, trading too big, which can accelerate our arriving at bankruptcy state, loss of all resource, all equity. You know, this is a cognitive bias. Why? Remember I said a few minutes ago, markets are infinitely complex. We have not yet developed supercomputers well enough, appropriate enough, relevant enough to understand the complexity of financial markets and things like them, like weather systems. We're approaching, we're doing better, but we don't clearly get it. So if supercomputers at MIT and Caltech, as I always love to say, or any other great institution of learning, or any Silicon Intelligence aligned, or even the collective of all carbon-based intelligence, you and me, human beings, we can't get it. That's so how can one individual brain, you could have a 200 plus IQ, and computers in terms of certain types of processes, calculation, they way surpass carbon-based human intelligence, but they're not as good in other types of calculations. But the point is, the complexity, there are infinite number of solutions that are aligned with how the current state of a market and its future course. Because it's implicit to me and to anyone that's trading. We don't talk about it. We don't make this explicit, but we understand there's no way I can understand the complexity. So it's very comforting to, if I see one possible solution, it seems to, it resonates with what's out there. Let me grasp onto that. Well, that's actually necessary, but it can also, I'm not saying because it's necessary, it's free of side effects that can be disadvantageous or adverse to our objective. That's all. It can be. So we have to be careful about it. And that's just, it's a consequence. It arises out of our incapacity, my brain, your brain, the collective of all human intelligence aligned, whether we connect it to a silicon supercomputer, a paralleled computer, a quantum computer, and anything else that is silicon or any other type of intelligence, whatever it is, we have not yet acquired a degree of comprehension sufficient to understand the market. And systems like it. Same thing with the weather. Weather patterns are equally, if not more. I don't know. They're similar. They're because they're infinite solutions. So we have to simplify that. And that's what the point of analysis is. So psychologically, our internal state might, because we're aware of this on whatever level we are, our reroute, our attempt to get around that problem often creates a new problem, which is hindsight bias. After something's happened, we retroactively say, oh, I saw that all along. And that can be problematic for the future. Here's a critical point, making the jump. And this is where this problem occurred to me or with me in my own trading, and then as the next slide after this, subsequent slide will show, just in the last 48 hours, I made a big mistake. And and you'll see why, and this slide illustrates why. Partly it was also, I made the mistake as a result of I was worn out, but the point I want to make, to a large extent, however worn out or physically tired I was or lack of energy, that was a lesser reason why than what the slide is bringing out. Here on the left slide is your analysis. Remember I said at the beginning of today's presentation, there are 3 spokes within the wheel of what it takes to be successful as a speculator. Analysis, risk and bankroll management, that's money management, and psychology. Now, that's my view. Not everyone might agree. I think uninitiated traders, it doesn't really matter if one trader or investor agrees with another. That's irrelevant. I'm just giving you my view as best as I understand it after 30-some years in the business. But most traders focus on the analysis as reflected in this slide on the left side. I don't care what so the 2 basic camps out there or philosophies, fundamental, technical. I could have put quantitative, the quants, you name it, cyclical. It doesn't really matter. There's the analysis, the point of which is to, hopefully if it's somewhat robust and worth its salt, get you to it locates good trades for you. It identifies for you, hopefully more often than not, some edge. And that's the point of analysis. So that's essential. Okay, so you do your calculations, you follow your analytical procedures and process, and you come up and derive some outputs. That's fine. Insofar as it goes, you haven't made a dime. You could put it in a book, you could write it down. It has its energy, but its potential. It's not realized. It's not kinetic. Hasn't done anything. Hasn't changed your lifestyle, unless it has somehow in a mysterious way. I don't know how, but I do know one way. It's got to transmute, and you've got to shift and convey and deliver. You've got to send the results and sell the results and you've got to sell it. Let me just be to the point. To your internal state. That's represented by going left to right. You've got to take that result of whatever you did on the left side, and in the order of events, sell that conclusion or output to your internal state. And it's got to be so powerful and potent, it forces you to lift a hand and push a key on your keyboard, so that in turn on the chain of events sends an electrical impulse via Wi-Fi or a physical line somewhere on this planet, so that an order is placed, so that a position is established, so that the market with the elapsing of ticks off a clock somewhere, depending on how the market moves, with vis-a-vis the order that you've established, an outcome can occur that will either be profitable in dollars and cents or incur a debit in dollars and cents. If that chain of events does not occur, you could have the greatest analysis in the world, and you'll probably be a great author, or what we refer to in this business, analyst. In the world today in 2016, we've got all sorts of media outlets, CNBC, you've got the pundits. All day, 24/7, we are bombarded with analysis, which is containers of information, which is really containers of energy. And understand that there's kinetic energy and there's the contained energy, potential and kinetic. Potential is just that, waiting. It's contained, but it hasn't acted on, hasn't moved anything. No work has been done. In order for work to be done, force through distance, there's got to be a release of that potential, so it becomes kinetic. Okay, here's the point I want to make without belaboring this. Think about the number of times you have looked at a price chart. This is a very specific example to illustrate a more general concept and a broader idea, and said to yourself, it looks like the market's going to go one way or another, and what you thought was going to happen actually happened. However, you did nothing except watch the market move. You did nothing except watch the market move while you anguished over all the money you could have made. Well, probably there's a reason. There are many reasons why one way or the other, you did an ineffective sales job. From the left side of this stuff over here, your analysis did not, the results of which did not make it over to, didn't make that transit across the ocean of whatever to sell it strongly enough to what's going on inside in this man, with the gears did not turn the right way, with the right speed, with whatever, to cause him to send a signal to his fingertip to push in or pick up the phone in the old days, or push or pick up his finger to press a key to make to act on a decision that the output of the analysis was imperative, suggesting he or she should do. So it died a thought, or it died. It's still potential energy, but good luck with making money on that. Case in point, this is a trade. Here's hesitation in the bonds. This was what I alluded to. Weeks ago, I determined, based on some of my, go back to the previous slide, stuff I do over here on the left side of this picture, and it's irrelevant for this webinar what it is. Just suffice it to say, I knew weeks ago, May 16th, there would be a turn in the bond market. May 16th, let me see when that was. Today's Thursday, that was Monday. I'm simplifying, but to illustrate a critically complicated point, or actually it's not complicated, it's simple, it's not easy. I make a clear distinction between the concept of simplicity versus ease with which information is acted on. Suffice it to say, I knew with probably 95% confidence weeks ago the bond market, Treasury bond, if you can see this chart, was going to turn on or about May 16th. Well, in this case it did. But I didn't act on it until yesterday morning. Why? Well, there are many reasons, or a couple of reasons in particular in my case. But a primary factor was I did not strongly enough take the information that I knew, as illustrated on this slide, and get it over to the right side of the page. And so the point of this concept is, doesn't matter. May 16th is irrelevant insofar as it relates to my objectives of increasing and maximizing my dollar and cent return in my trading account. It's correct. It's right in retrospect. And my response to that is, so the heck what? It not only does not increase my dollar level, my equity chart, if I were graphing it like Larry Williams says we should do, doesn't go up. That's bad in and of itself, even if it didn't go down. You know why it's bad? I have another account. I call it my emotional account. Go back to that slide. Anguish. How frustrating is it? It's one thing when you don't make money and you didn't have any expectation that you had a shot to make money. Or even more extreme, You knew you had no potential. You'd have no understanding of the situation. Therefore, you have no odds based on your analysis and tools to make money. Okay, that's bad enough. That's somewhat frustrating. How much more on the continuum of possible degrees of how distressed one can be emotionally if you knew and saw something coming and you don't even know why, objectively speaking, you didn't put it to use, which if you have, you now have confirmation you could have made money. Well, here's at least in an explicit superficial sense, I know this. Here's what I know about that, why that phenomena can occur in terms of the order of events or the chain of events. One way or the other, somehow you didn't make this, you didn't transmit the data. You didn't ship it to the right location in the right way so that you didn't do an effective enough sales job on your internal state. And that has nothing to do with what most traders think is important to making money in this business, and it has 90% to do with what I'm talking about today. You can be the greatest analyst under the sun, and I know some of them, and you can be a pauper. You can be out, you haven't made a dime. Yeah, you'll make money and you give it back, you make money. But I do know a critical way to counteract and ameliorate that situation is you've got to focus on this process, this transit. You've got to make sure that the information is sold to this side of the screen. Otherwise, you write books. Chalk it up to that. And I'm saying that to be facetious, but it's true. Okay. Here's a case where same thing. Now, may I make a little money? I got in late yesterday. I could have got in on Monday. And look how much more money. Let me just show you guys, if you can see the price axis here. I would have sold this market at 166 something if I had done it on the day that my analysis told me to do. You can see if you can see the scale here, we were up between 166 and 167. We're now down. We closed today in the bonds basis June 164.07. That's right around where I got in yesterday. So I'm not down, but based on, and it is what it is, based on an ineffective sales job. Has nothing to do with analysis, but it has everything to do with what we're discussing today. One's internal state or the emotional biases that disrupted the process of what I call myself doing, trading. Well, I was ineffective, not because of anything stemming from the analytical componentry, but 90% due to this psychological componentry. Ineffective. Now, there might have been a reason why I was ineffective. Maybe because I did not clearly understand that the process of speculation is immersed in and am all about and is probabilistic. A trader might say, well, it might have been a good reason why they didn't effectively ship that information of the analysis over to the internal state. Maybe they were waiting for more conclusive evidence. Often, and that's a potentially viable and objective and reasonable counterclaim. Typically, it's not viable, and it's an inappropriate and empty argument, and the reason is because it assumes certainty. We are in an inherently uncertain probabilistic enterprise. To the extent you will, and see, this is the disconnect between many things in the world and our business. We are in a business purely, solely, completely based on probabilities. Other things in our existence have certainty. Not everything, but many things. And so we have to certainly adjust our internal state whenever we put on our investment in speculative cap to realize I'm shifting from one, I'm coming out of the sea, I'm going on to terra firma. I'm moving from land to sea. Two different environments, and we must function completely different. If we expect to function, as an air-breathing way, when we move into the aqua or marine environment, and we don't have an aqua lung on or a set of gills, good luck with that, and vice versa. If I'm a fish and I attempt to live on land, good luck with that. Two different realms, two different modes of operation will set us off in the right direction. If we attempt to live in one realm with the apparatus designated for an alternate realm, you're not likely to be successful. This is another example. I think this was yesterday. Yeah, I was actually consulting with someone, and this is a euro. The previous slide was a trade that I disadvantageously adapted, and I'm still short in the bonds, just as a for those of you who might be interested. Okay, this is Euro USD Forex pair, and we were looking. This is an hourly chart, or is it? I don't even remember. But in any case, it's a Forex example. All this stuff up here, little evidences of some of my analysis. It doesn't matter. This is not a seminar on ADX oscillators or RSI. What is important, and it's not a seminar on support and resistance, but what is important is that the outcome of my analysis, however you worked at it or however I obtained it, told me that this line, this horizontal line here, I've written in support, and I actually told the person, place an order underneath the support to go short. I also gave them another way to do it if they were more aggressive, but on a breakdown below support. And in my head, I said, okay, as soon as I hang up the phone, I'm going to do the same thing that I just suggested. And look what happened. And I'm not suggesting it will always happen. I'm suggesting it did. I'm not suggesting it did. It did. I'm suggesting that by not acting on what I knew, I am in this state, anguish. That's all. And the reason is it's an ineffective sales job. That's essential. You must take the output of your analysis and transfer it appropriately and wholly and strongly enough to your internal state. Otherwise, it will remain potential, and you will never see the kinetic attributes, the real world results, and you will be that will tend to fester and foster and reinforce your degree of distress and or anguish. How to make the jump. In order to make the jump, you must identify the characteristic that separates the consistent winners from everyone else. Here it is. Winners have attained a mindset, unique set of attitudes that allow them to remain disciplined, focused, and above all, confident in spite of conditions. Forget the conditions. We remember, conditions are important if we are operating in a realm of certainty. Remember, conditions are going to there are infinite possible conditions that can arise in a probable terrain, in a probabilistic terrain. Everything from A to Z. So why focus on conditions? Therefore, they are no longer susceptible to common fears and trading errors that plague others. That's true. The obstacle. Emotional pain and financial disaster are common among traders. Yeah, that's true. It's a fact. It's a condition. I don't want to focus on it. I want to focus on understanding the terrain within which I operate, probability spectrum, because trading is full of paradoxes and contradictions. What's a paradox? I don't know. I mean, there are many definitions. I have some sense of what it is. What I sometimes think of it in terms of what I refer to as cognitive dissonance, where two things, any one concept or statement or idea that, or a given idea purports a conclusion. A separate idea purports an opposite conclusion. They are both simultaneously correct. I guess that's an example of a type, or that's getting close to what a paradox is. I don't know that it is exactly, but two things that the truth, you know, I had a slide in an alternate webinar I did months or if not years ago, where all I had on the slide was the statement on the next slide is true, and so that was the statement. And then I moved to the next slide, and the statement there said the statement on the preceding slide is false. That's kind of an example of a paradox. It sets things in motion. Kind of, how do you reconcile two opposites? I guess. Anyway. Emotional pain and financial disaster are common among traders because trading is full of paradoxes and contradictions. That's true, as is anything that has infinite complexity and is thereby thought of and apprehended via, we think of it and put it in and encapsulate it in terms of probabilities as opposed to certainties. Anytime the word probability comes up, it immediately means we don't know what the heck we're talking about. If we knew what we were talking about, we don't have to say it's X% of the chance. There's no likelihood. It either is or isn't. It's absolute. So the moment I hear anyone say, oh, it's 90% chance of this or a 65% chance of this, you immediately go, no, that's code for saying there's incomplete knowledge and understanding about the situation or the phenomena at hand. By definition, no exception. Contradiction. Unsuccessful traders are obsessed with market analysis. I love that concept because for those who haven't heard it before, if you're like me, and you may not be, but that'll get your attention, because for the first part of my career, for the first 10 years, I thought being successful was a consequence, a direct, or if not perfectly direct, to some way, shape, or form related to how good I could get my analysis, how much acumen I could acquire, how much understanding. Unsuccessful traders are obsessed with market analysis. Now, understand, let me qualify that statement. There's no implicit cause and effect here. It's just stating a fact. Unsuccessful traders, and it's a generalization, it's not saying all, but generally speaking, traders who don't make a lot of money are really good at analysis. And they're obsessed with it. That's pretty easy to understand, I think. Yeah, if you're not good at one thing, you focus on your strength. I'm real good at analysis. I can't make any money, but I can, therefore, since I realize that at some point, and I've passed a certain threshold, let me focus on what I can do. We all play to our strengths as human beings. They crave the sense of certainty that analysis appears to give them. Yeah, if I get 10 things that tell me and line up and agree, I'm starting to feel good. I'm on to something. That gives me a sense of accomplishment. And as human beings, remember, we're humans before we come into this subset of human activity called investing. So I carry over some traits that might be life-enhancing and further my success in a broad sense of life, but could curiously have attributes that in a very defined arena, it could be the death knell of me. Got to be very careful of that. Unsuccessful traders attempt to create certainty where it just doesn't exist. How ridiculous and absurd is that? Ironically, once the fact that certainty doesn't exist is accepted, an alternate certainty is derived. That is, the absolute certainty that certainty doesn't exist. That's one of the most important things I want to say today. And it's an outgrowth of the fact that we are in a business of probabilities. Probabilities, the moment the concept of probability is thought about, it immediately, you know, people don't know what they're talking about. Or let me tone that down. There is incomplete understanding by definition. If you have complete understanding, there is no necessity to ever even braze the specter of probability. It either is or it isn't. It's definitive, period. The moment we have to talk, think in terms, conjecture in terms of probabilities, implicitly it means we have less than ideal or optimal understanding of the phenomena or the situation or whatever it is, the topic, period. Contradiction. Unsuccessful traders, let me move on. The answer, learn to think in probabilities. And so this little graphic here, a circle, think of a spectrum of 360 degrees of probable outcomes. I tell every trader, every investor, new and old, and myself included, speaking to myself always, think of the infinite circle, never, no beginning, no end, alpha and omega, probabilities. Infinite, you know, we break a circle up into 360, but that's arbitrary. You could be any number. But there is a continuum of probable answers or outcomes. So the more we immerse and completely accept and understand and fully realize this is we will begin to reduce the distress and anguish emotionally, and we will also, all things being equal, I'm not saying that alone, we got to have edge. What's another analogy? I read in a book somewhere, someone said, if Darryl Strawberry had no intrinsic talents as a baseball player and went to a positive thinking coach chances are very great he would never have been a great athlete. You know, if you have no talent whatsoever, and that's analogous in this business to our edge, if you don't have your skill set that leads you to do what it is that's critical and germane to that thing you're doing, and you go get your internal state, the psychology correct, you probably will, you know, unless you're a quirk of probability, circumstance, and outcome, an outlier, probably won't have any success in that field. But using Darryl Strawberry as an example again, had he gone to a psychological coach, bringing prima facie prior to his getting coached on his internal state, could have been that much more of a, you know, that would have energized his skill set that much more. Learn to think in probabilities is the key. What does this mean? Trading is inherently risky. In other words, no trade has a guaranteed outcome. Therefore, the possibility of losing money is always present. Naturally, someone might consider themselves to be a risk taker in this environment. That's the prevailing environment versus here's the counterman, here's the response that will work us towards a solution. The best traders not only take the risk, they have learned to accept and fully embrace that risk. To whatever degree a trader has not accepted the risk is the same degree to which he or she will avoid the risk. Let me repeat that. To whatever, if you don't understand that it's a risk, it is by definition risk. The moment you think about trading or investing of any sort, any type, any instrument, doesn't matter. Those are the details that this is universal to any and all of the above, whatever you do. Short-term trader, long-term stock, bond, it doesn't matter. It's irrelevant at this level. To whatever degree a trader has not accepted the risk is the same degree to which that trader will avoid the risk. Well, how silly is that? Trying to avoid the unavoidable, something that is unavoidable, will have catastrophic effects on your ability to trade successfully. You're spinning your wheels. Steps in probability thinking. Number one, anything can happen. Every time I pull the trigger and enter a position, I know that anything can happen. I fully expect that. I didn't say I want that. I said I fully expect that because that's the realm. That's the ocean within which I'm swimming. I want to make money, but I'm not expecting that. If it happens, it happens. I desire that ultimately to the nth degree and beyond. But understanding how, however ironic or ununderstandable it might be, the way to more frequently achieve the desires, if your objectives and desires are maximal financial return, is to paradoxically expect anything can happen. You don't need to know what is going to happen next in order to make money. Now, I didn't say that knowing what this item number 2 does not say is knowing what's going to happen next, like in the example I gave a few slides ago where I knew the market 95% probability would turn, the bond market in particular would turn on this past Monday. I'm not saying that's going to hurt you. I'm saying what this item says is if you don't know that, knowing that alone is not sufficient to make you money. I don't need to know that in order to make money. If I didn't know that, I could have made money. It could have made money. Number 3, there's a random distribution between wins and losses for any given set of variables that define an edge. That's critical. As such, we ought not be myopic when we're grading our performance. You have to have a wide enough grading period, a long enough grading period. A lot of day traders are guilty of this, and that's why most day traders lose money, because they are evaluating and self-absorbed and evaluating trade by trade. Micro evaluation is the death knell of all traders, regardless, and that it's relative. Whether you're a long-term trader with a window on average of months to years or longer, or a swing trader, position trader, day trader, hyper-frequency trader. If you too frequently assess your performance, you're that too small a sample size that is going to bubble up and reflect your performance is an inappropriate, it does not, it's too different. It's not your distribution. It's assuming certainty, and it's an inappropriate mechanism to grade performance in a realm of probability. It would be a relevant mode of grading and assessment if we were in a realm of certainty. We are not. Two different grading systems are appropriate in two different stages, two different realms. An edge is nothing more than an indication of a higher probability of one thing happening over another. Every moment in the market is unique. So I didn't come up with this, Douglas did, Mark Douglas. So you got to think about that. How to embrace risk. Distinguish the micro from the macro. The macro, a particular pattern, may have a certain edge. Any pattern. I could replace the word pattern with relationship, model, indicator, an RSI, a stochastic, a moving average cross, a candlestick formation, a head and shoulders pattern, an Elliott wave count, a chaotic phase space diagram, you name it. Doesn't matter. A pattern has a certain edge. Edge implies frequency of outcome of a certain type. Immediately we're talking in terms of probabilities. You immediately should understand it's not certainty, it's not definite, but there is a certain chance, but that chance sometimes on the macro, the big outline, the picture, only manifest in the macro. The micro, okay, whatever the relationship for a head, whatever, 70% of the time a head and shoulders is market reverses. That's a pattern, that's an illustration of the I don't know if that's the case or not, but let's say every time you see a head and shoulders, 70% it's a trend reversal. That's the macro statement or description of that particular relationship or phenomenon. The third statement down, from the micro, at any moment, underlying market structure is different. I'll even I should have been more precise. Well, that's true qualitatively. Maybe let me add a quantitative indication to that. There are an infinite number of ways by which, microscopically speaking, a particular macro global pattern can emerge. And that's why no indication, no model, no pattern, no anything of an analytical mechanism by which you can obtain and sometimes get useful information about the system, the market you're studying, nothing works perfectly because of the infinite ways by which any finite number of macro patterns can manifest. All it takes is one. Now, to be a little more precise, the number or the magnitude of the ways by which a macro pattern could manifest microscopically is aligned with the number of traders in a market. The greater the volume, the more the possibilities. So I got a million people all over the planet following a market, trading in a market. There are a million possible ways, or no, excuse me, I've forgotten. I think I'm not sure if it's a million factorial or something it's a power of something. But they're potentially, I should say, because I don't recall the actual numeric arithmetic permutation by which you can determine precisely the number of ways in which a macro relationship can manifest. Suffice it to say, it's mind-boggling. All right. This is why no particular pattern works all the time. Cognizance of the above will keep you from discriminating edges. All right. The final answer, detachment. You must be completely detached from any and all financial outcomes. Yeah. You must be completely detached from any and all financial outcomes. That's the most important thing I can tell any investor, any trader at any time, that as to what they should do to be successful. That overrides anything I can teach or you can learn as a system, as a mechanism. That's more important than if you didn't have an edge. Even if you don't have any edge, you can get that. You could borrow that. You could steal that. One way or the other, some way you can get some edge. You don't even need an edge you don't need to win 50% of the time. You can still make a fortune if you couple it with, if you understand this concept, complete utter detachment, and you maybe have some good money management. The final answer, being completely detached. That's why the rocket is detached from the Earth. It's leaving. It's not chained down by anything. It has no connection to anything. So I wanted to have that little illustration metaphorically illustrate. I cannot emphasize this enough. It's free. And as such, the moment you become free from any connection or attachment is the moment even if you did not intellectually understand the importance of thinking of your activity in this business as a trader as being one of probabilities. Even if that doesn't make sense to you for whatever reason, if you're detached, you don't care. You don't even understand that. You don't need to. It's irrelevant, and it's less important. What's important is you're setting yourself up for trading correctly. If I'm detached from any outcome, I won't have any hesitation on cutting a loss when I should. I won't have any hesitation on any particular outcome that might cause me to stay or not stay in a winning position long enough to let it blossom fully for full profitability. Oh, one quick note. One of my teachers years ago, Jim Sloman, told me this same concept. He said, Glenn, nothing matters. He applied it to life. Well, yeah, that's a limiting view of detachment. Is lack of confidence holding you back, or is lack of edge lacking or lowering your confidence? That's the analogy that I mentioned earlier. Yeah, I'll leave that. That speaks for itself. Psychology, that's a redo of what I said earlier. The future, a new perspective of trading psychology. This is just, okay, measurement versus direction. Imagine there was an oracle teaching, and there was the disciple, and the oracle poses a question to the student, and the student's response is, in a way, I suppose, but here's the point I want to make on this slide. A student says, I use my voice, my intellect, everything my skill set, my tool set, as a ruler. I measure the words of my teachers with my intuition, with my mind, with any and all related faculty. That's the response of the teacher to the universe, or of the student rather, to the teacher, the uninitiated, the one that's trying to seek some understanding to further their cause. Again, the point that the student makes to the teacher is, I try and assess and understand something using my faculties, whatever they might be, emotional, intellectual, etc. And here's the important point, the juxtaposition. What I don't do, the student tells the teacher, I don't originate a thought or idea. What I do is I evaluate ideas and a thought. Two different polar opposite activities. Evaluation, assessment, measurement versus creation. The teacher says, and the teacher's response, I've just mentioned it. Why do you do this? Why do you assign yourself the diminished role of measurement, metrics, analyzing, instead of creating an invention? Well, I understand that a lot in this world, in our universe, has benefited. We've gone a long way by virtue of measurement. The entire, David Hume, or whatever his name was. I know it's Hume, I forgot, I think his first name was David. Anyway, the concept of evaluation and measurement and objective reasoning. It's taken us a long way. I'm not saying it's bad. I'm not saying it's good. I'm just saying it is what it is. These are just words. Language is woefully insufficient in adequately assessing and giving or providing description and understanding or comprehension. But there are two different phenomena. There is measurement and assessment, and there is creation. Psychology, for the most part, in the way what most authors have, and everything I've said heretofore in this presentation has had to do with adjusting our internal state so that we can mitigate and dampen and ameliorate those biases behaviorally and emotionally that could be adverse to our speculative efforts. And that's one thing, but it falls under the category of measurement because it means we can first, we have to identify a problem, which is a measurement issue or one of assessment, and we make adjustments to it. And we do so in that internal state realm. Remember I said a critical component of being a successful trader had to do with taking the results that you derive analytically and transfer. There's necessarily in the order of events that is consistent with being a profitable trader. From a dollar and cent standpoint, we must then transfer that information, that energy, in a way that it is effectively sold to our internal state. Barring such a sales job, however much money you make, it will never be maximal or optimal to what you might otherwise have made if you are an effective salesperson of the fruit of your analysis. All of what I just said is true, but it is still it refers to what the student was referring that they do. They are in the mode of evaluation. Here's the next generation of psychology, understanding that there is an alternate ego, if you will, of psychology, of what is the internal state of an entity is capable of, and that is of creation and invention. That's why I have this little metaphorical picture here pointing. We can utilize our internal state and determine the bullseye, the target, by virtue of pointing our mental state in a direction. What you're reading, what I'm saying now, you may not find in a textbook because I haven't written this yet, but I'm alluding to, I'm kind of backing into it for those of you who are with me on this. All right. Example of measurement paradigm, and that's what is leading the day here. A basic premise of technical analysis is that all information one needs is contained in the price. By extension, each and every day, and in fact each and every moment, a market's price is composed of a time and price component. In other words, this space-time, or more specifically price-time continuum of energy, is what we are observing when we view a price chart. If and when this energy, which represents the market, moves by a certain specific amount of price time, it reaches an equilibrium point of balance. Because by definition, a balance point is so sensitive, it marks or corresponds to a point of change or a turning point. Essentially, tops and bottoms are points of resonance that allow energy to come in and overflow the system so that it changes. That's just it doesn't matter, it's one view. What I just read is a view of why market turning point, tops and bottoms, and markets reverse and do what they do. It's one view, and it's a view that is an outgrowth and is an extension logically of objective reasoning. And everything I've said up to this point really refers to the importance and the benefits one can derive if complementing your analysis and your edge finding tools with an appropriate mental state, and ensuring that the mechanism of transferring the output of your analysis again is properly conveyed to your internal state to the point where it compels you to act on that, so that over the course of distributions you can consistently see dollar and cent equity curves moving closer and closer as a limit to your objectives and what you so desire. That's one paradigm. Here's the alternative. This is the future. Versus active psychological paradigm, a recasting of the old. A basic premise. So I'm essentially going to convey the exact same content of what this slide says, but I'm going to recast it in a completely different paradigm. A basic premise of psychological and/or behavioral speculation. A basic premise that what I want to imply. I'm going to state this explicitly. What I'm saying is, the internal state is no longer the passive participant, the receiver of their derived information, the energy from the analysis. It has shifted roles. It's no longer the receiver, it is the transmitter. A basic premise of psychological and/or behavioral speculation is that all market motion, past, present, and future, originates. All market motion originates and is informed by energy which comes from you and me. That's new. If it is, if whoever's out there is with me, great. If you aren't, then that's why we're recording. By extension, each and every day, and in fact each and every moment, a market's price is composed of a time and price component. That's pretty much the same as what the previous slide said. In other words, this space-time continuum, or more specifically price-time continuum, the vertical axis is the space or price. The horizontal is your time. That's all. Of energy. It's a continuum of energy, is what we are creating when we interact with the market and its chart. If and when this energy which represents the market is moved or manipulated. How might you move or manipulate? How might this energy be moved? Well, whatever the student was saying to the universe or the teacher, that which understands more deeply and more comprehensively what he was making inquiry concerning. Whatever that is, all right? Whatever is on that internal state of that participant, it can be projected outside of itself, to the world external to itself. So in this fourth paragraph down, 1, 2, 3, yeah. If and when this energy, which represents the market, is moved or manipulated, how do you do that? By projecting it from within to the external. In a specific manner, through certain amounts of price time, it reaches an equilibrium point of balance. Because, by definition, a balance point is so sensitive, it corresponds to or marks a point of change. In other words, the market turns. Technicians call that tops and bottoms. Economists refer to it as regions or zones of excess supply, if it's, from an economic perspective, or excess demand, if it's a bottom. A top is supply or in excess, a bottom is demand in excess. Same underlying, exactly the same phenomena, multitude of ways of describing it based on one's whatever is important to you as your perspective. When the collective energy reaching the market achieves a sufficient degree of resonance, sufficient to create an energy overflow, the market changes, of course. Kind of analogous to that I don't know, I may be aging myself. If years ago, it was a television commercial, is it Live or is it Memorex? And they had an opera singer. Well, they had many versions, but one, it was referring to the sound energy filling up or resonating at such a high frequency. The higher the frequency of all wave and vibratory phenomena, the greater the energy. The lower the frequency, that's a fact. Sorry, those of you, I'm not just making this up. That's science, if you want to know, but it's based on wave analysis and frequency. The higher the frequency, the greater the energy. The lower the frequency, the lower the energy. It's just wave analysis. But anyway, so if you reach higher auditory notes, as we go higher and higher, you increase the frequency, you increase the energy. If there is a structure in your vicinity that is very fragile, such as a wine glass or a champagne glass, if it begins to vibrate as a resonance response to an auditory or a sound wave, it could conceivably vibrate so high, have so much energy, the molecular structure of that glass, let's say, or whatever the structure is, being relatively fragile, more fragile than the amount of energy it contained. Well, the energy has to be, there's a finite space and an infinite amount of energy, or on that relative degree, and the energy has to go somewhere. If there's no space for within which it to go in itself, there's one consequence. It breaks out of the space, and the consequence is the glass breaks. Same phenomena. That's why markets turn, tops and bottoms form. Anyway, the market changes course. Mental manipulation. Teacher, the universe responds to your directives, not your questions, hopes, and prayers. If you choose to define your future by telling the universe what you desire to experience and appreciate, you hold these thoughts in your mind with fierce persistence, the universe by its own design will respond accordingly. If, on the other hand, you ask questions or pray for answers, the universe will respond with a deafening silence because you have not given it direction. The direction I'm referring to is metaphor, like in here, we have a clear direction. And so that's a different paradigm. By the way, this final slide, I am not meaning to imply in any sense spiritual or religious connotations or overtones. I certainly am not saying, or this message is not meant to offend anyone's particular views on that, be they philosophical, religious, or whatever. When I gave this presentation initially a year or so ago, whenever it was, someone responded that they felt that apparently there was an offense that was taken. It is not in the slightest making reference to anyone's particular views of life or be they religious or philosophical or spiritual or whatever. I simply mean this to make a point. And it's not disparaging in the slightest when I say that it's a view. You don't have to agree with it or not. I'm just saying it is saying based on directing the energy from one's internal state, you get results. That's all it's saying. Okay. Folks, we have a few minutes for questions. If I am unable to address any questions, here's the information. Again, Peter Newman is the contact you would talk to. 800-339-8588 is our toll-free number at Pacific Trading Academy. You can also take a look at the website. And because we have recorded today, if you want to access this recording, contact us and they'll give you the codes by which you can access the recording. Let's see. Any questions? Thank you, VJ. As always, you're good to hear you and see you. Okay. I don't have many questions apparently. Rand was asking, I love that phrase, a bird in the hand is worth two in the bush. When it is, yes. Sometimes it is, although there are other times depending on how far the bush is and the whole host of innumerable variables, too numerous to mention probably. But it's each situation and its own situational outcome. Will the recording be sent? I don't think so, not proactively. I think you have to request it, or I don't know the details. I apologize for the interrupting. President is very, oh, thank you. Okay, but yeah, you can access this recording. Excellent, folks. Well, once again, it's been great. And again, if you have further questions on this or related, this was very specific topic on the emotional and behavioral and psychological components that I feel are salient in the process of trading. So I look forward to future presentations where we'll touch on something else, another topic related. It's all in the mix, and until such time, I wish you profitable, continued profits and trading well, and overall success and well-being. Until next time.